When you make a decision, such as buying a new car or quitting a job, you need to know and understand the risk that you're taking before you can logically accept that level of risk. And I think it really goes without saying that investing in stocks is not an exception to this. Luckily, there is a very effective measurement that you can use that, if you get to grips with, can really help you understand the level of risk that you're taking on and enable you to be certain you're not taking on more risk than you're willing to. This measurement is known as beta. Hey everyone, I hope you're doing well. In this video, we're going to be talking about what beta is, how it relates a stock to the rest of the stock market, how to use it to understand the risk a stock has, and how to know if you're using it correctly. Just before jumping in, if you like content like this and want to know more about the stock market and how to grow your money through investment, subscribe to the channel and put the notifications bell on so you never miss an upload. So beta, also known as the beta coefficient, is an aspect of the capital asset pricing model and is a measurement of a stock's volatility in relation to the volatility of the market as a whole. Volatility is just how much something changes. So if a stock is described as very volatile, it simply means that its stock price fluctuates a lot. Beta is a type of correlation coefficient, which is a measurement of how one variable is related to another. And so you can think of beta as a way of determining how correlated a stock is to a benchmark. The beta of a market, such as the S&P 500, is always 1, and the beta of a stock is determined by how volatile it is and how much it deviates from the market. So if a stock had a beta of exactly 1, it would mean that it is exactly correlated to the market index and follows its movements identically. The closest example would be an index fund. If a stock had a beta of 0, this indicates that there is no correlation between the stock's movements and the market's movements. This basically means that if the market moves up, so it's bullish, there's a random chance that the stock will move up, down, or even stay where it is. There's really no telling how it will move in relation to the market. Now if a stock has a beta of -1, this means that it's inversely correlated to the market, which means it moves in the opposite direction. So if the market as a whole was bearish and moved down, the stock would be bullish and move up. This doesn't necessarily mean it will be an exact opposite, but the stock will tend to move in the opposite direction of the market. As I said earlier, a market has a beta of 1. This therefore means that if a stock has a beta greater than 1, it is more volatile than the market as a whole and thus more risky. Whereas if a stock has a beta of less than 1, it is less volatile than the market as a whole and thus less risky. Interpreting the beta is straightforward. For example, if a stock had a beta of 1.3, it would indicate that the stock is 30% more volatile and risky compared to the market, but could therefore return 30% above the market. If a stock's beta were 0.7, this would indicate that it is 30% less volatile and risky compared to the market and may therefore return 30% less than the market. The reason high beta stocks are regarded as more risky than low beta stocks is because of their unpredictability and tendency to fluctuate. So how do we calculate beta? Well, as is the case with most financial indicators, you can very easily find a company's beta in its stock summary. However, I do feel it's important to have an understanding of where the number comes from. The calculation for beta is dividing the covariance of the return of an individual stock and the return of the market by the variance of the return of the market. Covariance is just a statistical tool we can use to show the relationship between two asset prices, and the variance is just how far data points in the market are spread out in relation to its average. I'm not going to go into detail about how to calculate the covariance and the variance in this video, but if that is something you're interested in, let me know and I'll make a video explaining how to calculate them. Investors can use beta not only as a way of understanding the risk of a stock, but also to diversify the risk in their portfolios. So while a beta of slightly less than 1 may not generate massive returns, it does carry low risk, whereas a beta of higher than 1 may generate massive returns, but also carries a higher level of risk. The mixture of stocks with different betas helps diversify the risk and reduce the chances of making massive losses. Now here's how you know if you're comparing a stock to the correct benchmark. The stock you're comparing should have a high R-squared value in relation to the benchmark. If it does, this means that the market you're comparing it against is correct and the beta measurement will be accurate. If a stock has a low R-squared value in relation to the benchmark that you're comparing it with, this would indicate that you're comparing it to the wrong market. and thus the beta measurement would be inaccurate. For example, if you tried to compare a gold ETF to the S&P 500, you would find that its R-squared value is lower than the market's. Once again, I'm not really going to go into detail about what the R-squared is in this video. However, if that is something you're interested in, let me know and I'll make a future video explaining that. But just briefly, the R-squared measures the proportion of a dependent variable's variance that can be explained by an independent variable, and you can calculate this through regression analysis. As always, I really hope you enjoyed this video and learned something new. If you do like content like this, please like and subscribe, and if you have any topics you'd like me to cover in future videos, put them in the comments below and I'll try my best to get to them. Thanks for watching.